So Lemonade is reducing their reinsurance from 55% ceded to 20% ceded. My initial thought that this was a bullish signal. We're going to get into lots of details around reinsurance in this video. And then also a little bit, just hours after that announcement, Daniel tweeted that reinsurance was done 100. This plan, this lowering of reinsurance was 100% by design, and at our election, it would have been easy to renew on their expiring terms. So we're going to discuss all these things in this video. And actually in this video, we're going to talk about what is reinsurance, how do we calculate it, model it now, how does it affect revenue numbers, and then visually understanding the relationship between reinsurance and gross profits. Then we're going to flip over to more of my model and think about, well, what does this 20% drop mean? What is reinsurance even for? We'll talk about that. Why catastrophic risks, I think, are not as much of a deal right now for their current book of business. Look at the surplus side of things, the surplus ratio, how we could maybe estimate what the surplus ratio could be. Look at their Lemonade model, then see, hey, what's our surplus going to be based on 55% reinsurance, 20%, another scenario, and then also see how profitability changes. So let's dive into this. So as I said, the reinsurance was renewed here, and I think this was very bullish, and confirmed by Daniel that this is bullish because they totally at their own discretion, management Lemonade decided to drop their reinsurance from 55% ceded to 20% ceded. So first of all, what are we even talking about? What is reinsurance? Reinsurance is just additional insurance for an insurance company. So they buy insurance on the reinsurance market, and then larger other reinsurance companies help protect part of their book of business and share some of the risk, especially for a growing company like Lemonade. It helps protect them and their balance sheet, their capital in case of a major catastrophe. So how do we calculate it right here? This is my Lemonade model available to my Patreon members. If you want full access to the model, feel free to join my Patreon. Shout out to everyone who's joined in there. Super, super cool. But here it is. You have IFP, so in-force premium. That's at any given time, your amount of premium that's on your book of business. And then as those policies are finished, so you complete a policy, it turns into earned premium. So I'm calling it gross earned premium, but you have earned premium that is earned when the policy is done. So it makes sense on a quarterly basis. It's around a quarter, 24%, 23% last quarter, around there. Depends, how much they're growing as well, but approximately around that rate of your in-force premium is going to turn into gross earned premium each quarter. You then have your reinsurance. I'll just scroll this over to the side here a little bit. Your reinsurance percentage. So in this case, it was 55% in Q1 and in the previous year. So 55%. And what this means is that they're giving away or ceding or sharing the risk of 55% of their gross earned premium. So that's your premium ceded, which turns out to 55% of your gross earned premium. Maybe I'll just actually zoom this in a little bit so it's a little easier to see these numbers. So that's the premium they're giving away to share the risk, more than half the premium, and then the leftovers is what Lemonade is fully taking the risk for. There's probably also more nuance and more details. I know there is more nuance, more details in exactly how this is all structured, but this I think is a good approximation and modeling of it so we can model and understand. Then you have, Lemonade gets back a ceding commission, a certain percentage of the premium they cede. So this 129 million or 55% of your gross earned premium, a certain percentage of that they actually get back as a ceding commission income. So in this case, it was more like, it's been around 25, 26, 27%. There's probably a few factors that influence this, but 27% in Q1. That means they get 35 million back in commission income in that case. And then you have reinsurance's total income is just how much they're paying, how much there's premiums they're taking in minus what they're giving back as their ceding their commission. Anyways, you get down to, for Lemonade's case, your revenue is simply your net earned premium. It's how much they're keeping plus your $35 million. So let's just pause and zoom in here, look at revenue for a moment. So I have revenue excluding investment income. You could add in investment income and get a total revenue figure here, but I'm just at this point in how I'm showing in my model, revenue before the investment income is Lemonade's revenue, which is just how much premium is left over for them plus their commission income. And this is, so revenue, in my mind, is not a great metric. It's not a metric I really focus on for Lemonade, because the way it's defined or calculated for an insurance company that has reinsurance structured, it's before they've paid out their losses from reinsurance. And if you have more reinsurance, well, then your reinsurance company is going to be covering more of those losses. If you have less, they're going to be covering less. So it balances and weighs out the effect of the reinsurance on your revenue. But if you have, for in this case, but this will swing the revenue number around, but will also swing how your claims are paid out and covered. So you'll see here in a second. So 55%, say in Q1, reinsurance had about $140 million of this revenue before investment income. But if you drop this to 0%, well, now you suddenly shoots way up to $234 million of revenue. Or if this was 95%, it drops down to $72 million. Or if it was 0%, if it was 100%, you drop down to $63 million. You're only getting your commission income. You're just giving away all of the risk, and you're getting a commission for acquiring that book of business and those customers, sort of a sales commission from the reinsurance company. So, but it'll swing your revenue significantly in the other direction. Versus 55%, you're now at 140. Or if this was 20%, it would shoot up to $200 million. So it really affects how your revenue is displayed. But then beyond that, you have a loss ratio. Say it was a net loss ratio of 82% in Q1, and it shows that the higher this loss ratio, the benefit of the reinsurance is that your insurance company is covering a portion of the losses. So you might have $192 million of total of claims and related expenses with the claims, and then $106 million is covered by reinsurance, $86 million covered by Lemonade. So, and then you actually have what I'm calling a profit after insurance losses, or maybe you could call it sort of adjusted, maybe you could call it like a gross profit of $54 million. But if, say, looking at this $54 million line, and now if, say, your reinsurance was 20%, instead of 54, it drops to 46. So it's a bit of a swing, but not nearly as dramatic a swing as the revenue is making. So if this was 0%, well, now it drops to $42 million, and if it was 100% reinsurance, it rises actually to $63 million. In this case, it actually gets better because they have reinsurance in place. So we're going to look now at. I basically took how all this math is played out in these lines, simplified it down into this equation form. We don't need to look at that. You can pause and look at it if you want. And then I've graphically displayed that here to sort of demonstrate a y-axis, meaning your gross profits, an x-axis between, we really only have to look and think about 0 to 1 being your reinsurance percentage that is ceded. So we're at 55% all the way to 100%. And then you have a line equation of your gross profits here. And in this case, this purple line, I have a slider that shows your loss ratio, your net loss ratio. So you'll see here, if I tilt this, say your net loss ratio was 83% like it was in Q1. So 83%. You can actually see as your reinsurance goes from 0, say you had no reinsurance, up to 100% of reinsurance, your gross profits actually get better. So you might think, oh man, which makes sense, because there's a certain point where if you have insurance, no matter what it is, maybe you own a car and in your first year you smash the car and it gets damaged and you get a full payout for the car, you maybe paid a small fraction of the price of that car for that first year of insurance coverage, but then you got paid out fully. Obviously, it was very advantageous for you to have that insurance in place for your car. So, and likewise, depending on what their losses are in a given quarter, your gross profits could increase or decrease depending on the amount of reinsurance you have and the loss ratio. So at 83%, it looks like this, and it actually gets better as you have more reinsurance, your gross profits. But if you lowered it way down, say they were 60%, let's move it there, your 60%, now at 100% or 0% reinsurance, you're going to have a lot more gross profits. Whatever this is, 90 some million gross profits versus 60 some million gross profits. If you reverse it at 100% or 0% reinsurance, if you had a 60% loss ratio. So if your loss ratio is better and better and better, as your loss ratio gets better, the steepness of the slope, it changes, and it makes more sense to have. If you're confident you're going to have lower loss ratios, it makes more sense to have less reinsurance because the slope of that line gets more dramatic and you get more profits the less loss ratio or the less reinsurance you have. 3%, and turn this equation back on. At 73%, it makes no difference. Essentially makes no difference whether they had 100% reinsurance or 0% reinsurance. It will change the revenue numbers, but your actual profitability, gross profit, will make no difference. So in a sense, it's I have 27% right now in Q1 for my ceding commission. This is 1 minus your ceding commission would give you the loss ratio where you completely break even. So I hope that makes sense. So at 73%, it does not matter. You will not change your profitability structure in any way. But clicking these graphs back on, one of these shows your 73% loss ratio. This red one shows your 63%, your 53% loss ratio, and then also, if you had an 83% loss ratio and a 93%. So you can see they all converge. At 100% reinsurance, it does not matter. All you get back is your ceding commission. But then at 0%, reinsurance, you have a much dramatic sort of swing in how your profitability could be. If you had, say, 53% loss ratio, it could be very high, and if you had a 93% loss ratio, it could be very low. It could be 16 million to 110 million, a very large swing if you have less reinsurance. But if you have more reinsurance, it becomes actually eventually no swing. So where they were at was 55% reinsurance. You can kind of imagine it's somewhere, in here, and you see this wide of sort of a spread between a 93%, 53% loss ratio. And if you move that down to a 20% loss ratio, now you have a much wider spread, which is what they're doing. They're increasing that spread. Of the sort of results you could have. So I hope all that makes sense. If this was too much math, you can just skip over this part, and the rest of the video will still be really helpful to you. So what does this drop from 55% to 20% really mean for Lemonade? I've shared some thoughts on reinsurance just last night or the other day with my Patreon members, and I said in this little quick write-up, I said, in my mind, the purpose of reinsurance, at least for Lemonade, is to lower catastrophe exposure. So if you have, going back to the graph, if you have a really bad loss ratio, it pulls that up, further ahead, so you have less extreme outcomes either way, especially if you have a really bad downside scenario where you have, huge catastrophe happen. So it lowers the catastrophe exposure, but it also allows the surplus requirements to be stretched further, because you see, insurance companies need to set aside a certain amount of capital. If they write policies, there's regulations that say you have to set aside a certain amount of cash, a certain amount of capital So in the case that you have major claims that need to be paid, you'll be solvent and can pay those claims, right? So that's the purpose of why there's regulators. Otherwise, you could just sell people hopes and dreams, take all their money, and then disappear or go bankrupt in the case of not pricing the risk correctly. But I think in Lemonade's case, especially I wrote this even before Daniel tweeted this out that said this was 100% by design at our election. They could have had 55% reinsurance if they wanted to. There was no sort of demanding or poor terms from the reinsurance companies. But I wrote this even before that, and I kind of, my mind, it said, I think the catastrophe risk for Lemonade is dropping because they've been non-renewing the worst home customers for the last couple years, and they've been very cautiously even selling new home to any new customers, and home, just so we get this straight here, home is going to have your very highest, worst catastrophic exposure. Maybe a car could be potentially damaged in a catastrophe. But a home getting burnt down and destroyed, that's a massive, tremendous loss. And you could have a whole pile of homes all burnt down, destroyed at the same time. It'd be massive, like an LA fire situation. That could be massive of losses all at one time versus other products like pet products, car products, renters products. They're even life products, just tiny slice of their business. Those are not going to be massive. They're going to be very, very small relative to home in the type of exposures they bring to major catastrophes. So in my mind, the catastrophe requirement is not that bad for Lemonade anymore because they've been reducing home. They've been very cautious with selling any new home. And then pet and renters, they don't have much catastrophe, and they probably feel very, very confident and very predictive in the loss ratios for those products. And then also car, they have a lot of data from Metro Mile over years. They've been tinkering and selling car. I think as they're not going to jump crazy, massive, sudden doubling, tripling of the car book, but they will be slowly sort of accelerating and pushing that book of business further. But I feel like they should be, in my mind, pretty confident in the loss ratios they'll get for car because you don't have, again, as much of those catastrophic swings. So if the requirement, if the requirements of reinsurance is a lower catastrophic exposure, and they don't have really as much catastrophic exposure, maybe less and less than they had in the past, then it makes sense that they would be dropping from your 55% to 20%. It makes sense that you would make that move. And then the other side of things is the surplus side of things. How much of premium do they need to be setting aside, and will they need to raise equity in the next few years? So Lemonade has given this ratio, an approximate ratio. It'd be much more complicated, I'm sure, varied by product and by state and all the different exposures. But you could kind of have an overall approximate ratio of the amount of your IFP you can write to the amount of capital you could need or cash or cash equivalents you need to hold on your balance sheet. And so they're saying if there was no, this was from Investor Day 1 in 2022, Tim talked about through this slide, and he said, if there was no reinsurance at all, you might average ratio might be 3-to-1. So you could write, if you wrote $300 of the premiums, you would need to have $100 set aside. But overall, with if you have reinsurance, it extends or grows that base because you're lowering the amount of risk that you are taking. So then you can have a higher ratio. You can grow faster and have a bigger, larger book of business or more premium on your book. And that's the concern for Lemonade is, hey, what if they grow way too fast? Their profits aren't coming in fast enough, and then they need to do an equity raise, and they get caught at a poor share price that they wouldn't want to raise equity at, and they can't do the proper raise, or they need to even do a raise. So this was back in 2002. They gave sort of a 6-to-1 ratio overall. That's how I've been modeling it in my model. I asked Tim here. We'll see if he gets back to us here. after on his post said, "Can you give me an approximate update of this ratio?" Even then, Aaron, if you know Aaron from the Lemonade community on X on Twitter, he sent me this equation that could roughly approximate this ratio, or the amount of percentage of cash needed. And you can just figure out the ratio based on this 3 plus 0.08 times the percentage of the book that is reinsured. And this roughly follows, if 0% of the book was reinsured, you get a 3-to-1 ratio, or a 1/3, 33% of the book of business, or a 3-to-1 ratio. So it also roughly follows the math for what we had. If you're 55% and you're at a 6-to-1 ratio, it roughly follows that as well. And so using this equation, you get about a 4.6 ratio, which is what I've plugged into my model as an update to figure out sort of the amount of surplus that they have. Over to my Lemonade model here, I have a copy of my model that had, a 55% reinsurance going forward. So 55% going forward through, till the mid 2030s. So based on 55% reinsurance and a ratio of 6-to-1 of IFP to cash requirements, you get sort of your extra surplus on top of what is required to be set aside. And I see this dipping. So even though their profits are going to kick in, they will be creating profits because they're growing. Their capital needs, the capital set aside, is also rising. And you see this so your surplus is diminishing, but then as your profits grow faster and faster and faster, it takes off, and eventually you're completely fine. So in this scenario with the 55% reinsurance, we had as low as, kind of just below around $500 million of surplus. Now, if we flip over to how my current model, how I'm modeling it right now, I have 20% reinsurance inside of there. And I have that ratio at 4.6 for your IFP to cash. And based on that, our surplus is only, slightly worse. It's more like 474 as sort of your low point in what your surplus could bring. You could also argue, well, this equation is just an approximation. We don't really know what it's going to be. So maybe you say if it was 4, maybe the ratio is not 4.6, but it's a little bit lower. You have to have it's a 4-to-1 ratio. You're still now down to $400 million of surplus. So still, within, it's getting tighter, but still very, I think, doable, very plausible in that scenario. Now I'll move this back to the 4.6 ratio, that equation, leave it there for now. Because basically to conclude that is that I think you could be fine. Based on that ratio, even if it's a 4-to-1 ratio instead of a 6-to-1 ratio, there's surplus. The way I'm modeling it, still going to be fine. I also have pretty aggressive growth. I have them 10xing the book of business through to the end of 2032 up to that sort of near start of 2033, that $10 billion of IFP mark. So if they even grew a little bit slower and then had more profits because they had less marketing expenses, this surplus would look better. Another thing Lemonade could do to increase the surplus if they felt like this was getting too tight, beyond just not growing quite as fast as I'm modeling, but another option would be to increase the amount. You use the synthetic agent program financing for longer. So in this model here, the same copy, I have 20% of your reinsurance set, but I have more synthetic agents. So instead of synthetic agents ending this year, I have them extending out 80% of their growth spend being funded through synthetic agents, just for illustration, all the way through to 2032. I don't think they would even do it that long, but for illustration to show the difference, you can see that everything else the same. In that case, their surplus, I'll just scroll over here, their surplus now jumps up to a low mark of maybe 650 million versus where were we here? A surplus of, maybe 470 million as your low point. So it jumps from 470 to maybe 6 640, 650 million, that sort of zone. And that's because they're saving more of their capital, as then they're using more financing from synthetic agents, and then that pushes it saves your capital now, which then allows you to have more surplus now. Of course, it's going to hurt some of your profits later on a little bit, because you are paying a commission on those synthetic agents dollars that you're using, but it helps your surplus in this sort of crunch zone. So that would be another lever they could pull. They just use more synthetic agents. That could help their surplus. Another possible option is they don't feel that the surplus, flipping back to my model, they don't feel that the surplus, right now is tight enough. And then as it gets tighter, maybe in a year from now, 2 years from now, they don't renew at 20%, but maybe they renew it back at 55% or 40%, or whatever it is, whatever that case is, if they feel like this cushion here is going to be too narrow. But bottom line for me is, I think this reduction in reinsurance from 55 to 20% makes sense, because they probably don't have as significant of major sort of catastrophic risks on the book of business. And then also their surplus, I think, is going to be fine. And they have a few levers they could pull, that could improve it if they needed to. But even in sort of a high growth, stopping your synthetic agents program at the end of this year, in that scenario, I think they could still be okay. And then finally, I want to look at how the change from 55% to 20% changes their earnings per share, their profitability, and as well as we'll look at when they might flip to adjusted EBITDA profitable and net profitable. In terms of your sort of grand zoom out profitability, my model for earnings per share, when you looked at 55% reinsurance, what we're looking at right here, you can see by end of 2032 at $8.15 per share, and this is annualized, so 4 times that quarter's earnings per share, $8.15 per share, or 2030 Q1 of 2033, it starts to jump up to $10.90. That's actually because they have the growth slowing and their marketing spend slows, so their profitability takes a sudden jump as soon as they stop investing quite as much for the future. And so you have maybe $10, $10.90 a share and $8.15 a share. And then if you jump to the 20% model, you have $12.79 a share and $9.93, so nearly $10 a share. So a pretty significant jump around that range. If you look out even further, the end of 2035, so more around 10 years out, at $31, almost $32 a share in annualized earnings then, versus say before at 55%, this was all 55%, you have more like $28, so $28.60 to $31, so several dollars more in earnings per share. So it makes a significant difference in their sort of overall cost structure and how profitable they could be. And then now flipping over to the model here, I will flip on the 55% side to the model and see when you're at 55% reinsurance, I was modeling they would start to break even maybe with, in Q4 of 2026 in terms of adjusted EBITDA profitability to maybe 4.4 million. And then if you flip to, you have more adjusted EBITDA profitability in 2027 through most of the year. And then net income, I had just barely starting to flip positive, just almost break even, just barely positive in Q4 2027. If you look at the model now at the 20% reinsurance structure built in, we slide that down there. Now, instead of 4.5 million adjusted EBITDA at the end of next year, I have more like 14 million adjusted EBITDA profitability. I still have that. Even Q3, I think, is more plausible because it's only 1.5 million, might be break even. Even Q2 is only 5.5 million. Minus 11 and 7.8 negative. So you're getting much closer. It's more likely you could have a Q2 or Q3 next year. And then again, profitability and more profitability through the rest of 2027. And then I have net income is being stronger. It might even happen, again, Q2 of 2027, Q3, and, I'm sure by Q3, Q4, it's probably turning profitable, potentially even by, earlier in 2027. I could see it depending on how you model it, right? So to me, overall, super bullish on this switch, because I think is going to make their business more profitable. It's likely, I'm sure they've weighed this decision very carefully, especially since Daniel said it was entirely their decision. And so they weren't being forced into this decision at all. So based on the fact that they've weighed this very carefully means I don't think they believe their surplus is going to be okay, as well as the catastrophic exposure is going to be okay. And my own thought is that, probably both those things are going to be just fine, are going to be okay. And so it's super bullish because you're going to become profitable sooner. All of our profits are going to be higher. So I hope this was helpful for you. If you want to go deeper into this model, you can join my Patreon. It's only $5 a month right now for people to get access. And if you have your own copy of this model, then thank you so much for watching. Remember, it's in the bag.